Thank you for joining us for this mid-year portfolio update. My name is Mark Atkinson. I look after investor relations for the company. Before we start, let me just stress that we're here to talk about the performance of the investment portfolio, not the wider company. That will be covered by the interim results out on the 1st of August. With me today to present to you are Craig Baker, Chair of the Alliance Witan Investment Committee, and co-portfolio manager Stuart Gray. We'll take questions at the end if we may. A number of you have submitted questions in advance, but please keep them coming in during the webinar using the Q&A function at the top of your window. With that, I'll hand over to you, Craig, to start walking us through slides.
Terrific, thanks Mark, and again, good afternoon. So many of you will have heard me and Stu talk about what we do a few times, but just as a reminder on this slide, we've tried to bring up what we do and how it's different from others and the key competitive edge that we think we're bringing to the portfolio here. So as a reminder, we follow a truly global multi-manager approach where we get who we believe are the world's best stock pickers to manage a portfolio of their very best ideas specifically for Alliance Witan. And then we at WTW are responsible for identifying who those stock pickers should be, wherever they may be found in the world, deciding what initial weights we should give them to ensure that stock selection drives everything, and then manage risk on an ongoing basis by evolving those weights over time and ultimately changing stock pickers where we think that is necessary and advantageous to shareholders. Now, in the interest of time, I'm not going to dive into the detail on what makes this approach stand out, but you can see there that we've got it on here. High conviction, so these best ideas portfolios that each of the stock pickers are running, but diversification because we're putting a number of managers that think about the world very differently together. So the portfolio can do well almost regardless of the type of environment. We do that with competitive costs because of the scale that WTW bring to bear, and we give it real exclusive access to stock pickers that wouldn't necessarily be available in the UK retail space and certainly not in these best ideas portfolios, and then do that under this approach that the board follow of a progressive dividend policy year on year, and that's well over 50 years that we've been doing that. So with that backdrop, let's dive into what's happened firstly in markets and secondly in the portfolio over the course of the first 6 months of 2025. So the first thing to say is that if you look at the full 6-month period, there's nothing too significant to write home about. It actually looks not wildly different to what you've seen over a number of periods over the last few years. Large cap stocks still did pretty well, small cap less well. A lot of momentum in markets with companies that have been doing well continuing to do well. The biggest difference, I guess, relative to some of those periods is that the US has slightly underperformed the rest of the world over the first 6 months, which is a bit different to what we've seen with US exceptionalism over the prior years. Technology was about in line with benchmark in the end, but you can see which sectors did particularly well: financials and industrials, and to a lesser extent utilities and telecoms, and some other sectors doing a bit less well, consumer discretionary in particular, not surprisingly with some of the things going on with US tariffs. But healthcare being the other sector that struggled. So overall, that's what the 6 months looked like. But what that hides is that it was a very different first quarter to second quarter. So first quarter saw the market fall about 5%. Second quarter saw it recover about 5%. And so in the first quarter, you saw a number of the growth names and technology stocks in particular that had driven markets over previous years really taking some falls in their prices over the first quarter, but some of those have recovered quite substantially in the second quarter. Others a bit less so, but overall pretty neutral over that period. So that was the backdrop to markets. What did that mean for us? Well, overall, we did slightly underperform the index over the full 6-month period. You can see there that was primarily stock selection. Overall, we slightly benefited from being underweight the US, and our sector positions didn't make much difference. It was stock selection within countries and within sectors that was slightly negative over the particular period in question. But perhaps a bit differently to what we've seen over the last few years, the fact that we were underweight the Magnificent Seven wasn't painful in the first 6 months. In fact, our stock selection within the Magnificent Seven was pretty good in the first half of this year. And you can see in particular our underweight to Apple added a significant amount of value, followed by our underweight to Tesla. But as a result, you have seen that slight difference. On the top right there, you've got the 3 stocks positions relative to benchmark that had the biggest positive impact for us, and the 3 that had the biggest negative. So being underweight Apple and Tesla were the 2 most beneficial. Being overweight Safran was the next most beneficial. On the flip side, being overweight Diageo, Icon and United Health were the most negative results on the portfolio at a stock level. If we then move into the next slide, which is one of the more relevant slides here, given our approach in the multi-manager piece, which is to look at who were the stronger performers amongst those stock pickers in the portfolio, who were the ones that did significantly worse on the right hand side. Those in the middle there did around about plus or minus, not a lot, versus the benchmark. So on the left hand side, the ones that did well, the ones on the right that did less well. So you can see there Dalton, our Japanese focused manager that we put in place about 18 months ago in a belief that there was a real opportunity in Japan for alpha generation. That seems to be playing out, and they've been the best performer over the last 6 months and a bit longer than that. Sands, one of the more growth-oriented managers, done particularly well over this 6-month period. But interestingly, it wasn't just about style over this month period because of the 2 different quarters, as I mentioned before, because Lyrical, a more value-oriented manager looking for the cheapest stocks and then deciding which of those are going to make it through, and they're not just cheap for a reason. They did well in this environment, and Metropolis, a bit more value oriented as well, also did well through the 6 months. On the flip side, on the right hand side, what you'll see is that Vulcan, GQG and Jennison were the managers that struggled a bit more over this 6-month period. The one I probably highlight in particular is GQG. GQG is the manager in this portfolio that tend to move around their portfolio more than the others. So they will sometimes look more value oriented, sometimes look more growth oriented. They are tending to focus on where they think the quality of the cash flows from the businesses look attractive, and that can be in different sectors at different times in the market environment. And so GQG have gone a lot more defensive in their portfolio in very recent times, and that meant that they lagged that recovery that was seen in the second quarter of 2025. So that's probably the biggest change that we've seen in the portfolio in recent times, and I know we'll come on to that in Q&A. If we flip on to the next slide, we've got a huge number of numbers here, and apologies for that, but we want to just make sure you have all of the information to hand, probably more useful when we put the slides up on the website at a later date so you can dig into it. But what we've shown is for this 6-month period how the the portfolio did in shareholder return terms and NAV total return terms in the first table up there, for the 6 months, for the 1 year to the end of June, and then the 3 years, 5 years, and the since inception of this approach, which is now around 8 years, 8.25. To the end of June. And you'll see the first thing to say is that, you know, over the long periods of time, the 3 years, the 5 years, the 8 years, exceptionally good absolute returns, as has been the case on all equity portfolios, really, well, certainly global equity portfolios. What we've then got in the next table there is what that's meant in relative terms versus a number of different ways of cutting the performance. So the first up is the MSCI All Country World Index, which is our long-term benchmark that we look at. That's the universe of stocks that we pick from. The next up is the AIC Global Sector, so that is other investment trusts managing global equity portfolios, and then the wider peer group. So this includes not just closed-end funds, the investment trust, but also all the open-ended funds in the retail space that are running global equity mandates. And that's the more representative one of what other managers have done, particularly when you get to the longer periods like since inception, where the AIC Global Sector has got some issues that the trusts that have had the worst performance have dropped out of the universe, and so it's not actually that indicative of what the returns were. So what you can see there is that we have in recent times, the last 6 months, but in particular the last 12 months, it's been a tough time for all active managers, but also us as well, relative to the MSCI All Country World Index. But over the 3 and 5 years, we've performed about in line with the index, well above the peer group. And so that's essentially what the story has been. Everyone's struggled relative to the index, which has done incredibly well because it's been concentrated in those small number of very large technology companies in the US that have really driven markets, much more concentrated than our portfolio is, and that's been beneficial for the returns on the index. So an obvious question is, you know, why have active managers generally, and us as well, struggled to beat the index, albeit with good absolute return terms, over the recent times? And what we've done here is we said, well, let's take the last 35 calendar years and show what proportion, and in this case we've used the S&P 500, the 500 largest stocks in the US as a proxy, but it's the same if you take it for the world index as well, but because the US makes up over 60% of the world, it's easier to use this index as an example. What it shows is what proportion of stocks that make up that S&P 500 outperformed the index as a whole in that individual calendar year. And what you'll see is that on average, it's about 50%. Indeed, if you go back 50 plus years, it's almost exactly 50% is the average each year, as you'd expect. Half the managers, half the stocks outperform, half the stocks underperform. But in individual years, that can be different. And it's a very tough time for active managers when very few companies are outperforming, and it's been driven by a small number of large companies. And it's a lot easier for active managers to outperform when a large proportion of the stocks are outperforming in any particular calendar year. And what you see here is that although the average has been 50%, there have been 5 individual calendar years where less than 35% of stocks have outperformed. Interestingly, 3 of those 5 years have been in the last 5 years. And then there are actually only 3 years where less than 30% of stocks have outperformed, and 2 of those were last year and the year before. So you can see this is an extremely tough period for active management. The other thing to note is the last time it was nearly as tough as that, you can see there is 1998, 1999. Got followed by 3 years in particular, but actually arguably about 6 years, where it was a lot easier for active managers to outperform, more than 50% of stocks outperforming in each of those 5 or 6 years, and almost 70% in one of those years following that tough period. And so that brings us to the next slide that then tries to show that in a different format, which is that you get these cycles where it's tough for active managers to outperform for a few years, and then it's quite easy for them to outperform. And so what we show on here is those two lines, blue representing the average active manager and grey representing the passive approach. And you'll see there that there was a long period of active managers outperforming, followed by the more recent period where active managers have struggled. Now, we've significantly outperformed the average manager during that period, but everyone struggled to outperform the index specifically. So we look at this and actually get quite excited about the opportunities from here in the portfolio, because if we continue to be upper quartile in terms of beating the average active manager, and at the same time the average active manager starts to have a much easier period for outperforming passive, then this could be a very fruitful time for our portfolio. And there are signs that that's starting to happen, with it not just being US exceptionalism and a small number of stocks being the only stocks that are driving everything in markets. And certainly when we look at the portfolio and try and understand the latent value in the companies we own, we get more and more excited about the portfolio every day. So that's just a bit of backdrop to the performance over the 6 months and longer periods. We'll get an opportunity to dive into that in more detail in Q&A, but at that point I'll hand over to Stu, who'll take you through what the portfolio looks like today and what's been going on at a stock level and manager level.
Fantastic. Thank you very much, Craig. So yeah, we'll start off with just the shape of the portfolio today. So this is our usual slide showing the managers, stock pickers in the portfolio and the allocations that we make to them. As a very simple reminder, we pick managers that we think are exceptional long-term investors, the best at what they do. And we try to blend together managers that are very different in how they think about investing, such that we capture lots of different and therefore diversifying ideas in the portfolio that gives the portfolio diversity and resiliency. So you can see that the stock pickers are not equally weighted. So how we put the stock pickers together is we want to blend them in such a way that the portfolio overall really tries to emphasize the stock picking skill that we think they have, and tries to minimize or diversify away big sort of macro calls like country allocations, sector allocations, style allocations, because we think taking risk on those more binary bets are quite difficult, and therefore we diversify those away and we focus on stock selection being the key driver. So the portfolio is intentionally built to not have a particular macro view in mind. It's designed to have diverse stock picking as the key driver. For those of you who have been following our sort of forums and discussions for a while, you'll know that last year we made a number of changes to the portfolio around the time of the combination with Witan. So I won't go over that again, but focusing on this year and year to date, we've actually made very little change to the manager lineup and indeed to the manager weightings. That's quite deliberate. So I'm sure there'll be lots of questions in the Q&A around what's going on with the world at the moment. Clearly things are volatile, things have changed. And what have we had to change in the portfolio? Well, the first key point to make is we have not needed to make material changes to the allocations. I think that's a very positive thing. I think making knee-jerk reactions to what's been very volatile and I would say flip-flopping macro environment, if you like, it's prone with danger. And we think making sort of big top-down calls in the portfolio is not a reliable way for us to add value. And it's really the stock selection which should be driving. So part of the reason why we have not needed to make allocation changes in a material way is because the managers themselves have been making stock changes in the portfolio. So the portfolio has definitely evolved in reaction to what's been going on in the world and the changing opportunity set that we have available. But it's been at the stock level more so than us making top-down allocation changes at the portfolio level. So here are the largest active positions in the portfolio. I'll make my usual comment on this slide, which is,
in a portfolio of around 200 stocks, one of the beauties of the Alliance Witan portfolio is that every single company in the portfolio is one of the highest conviction ideas from one of our best stock pickers in the world. And therefore, the drivers of the portfolio really is about all 200 or so stocks. It's not really limited to, it's only about 10 stocks in the portfolio. Nevertheless, we tend to show you the largest active bets. So the other key point I'd draw out on this slide is, if you've seen us present and talk about the portfolio for a while, you'll notice that the slide today has a lot more underweights in the largest active bets. And that tells us two things, really. First of all, it tells us a fairly obvious thing, that index concentration has risen a lot in the last few years. And therefore, if we choose not to own companies, those underweights are generally bigger today than they have been historically. It also tells us that actually we have chosen to not own some of these larger stocks. In previous years, we have owned many of the large companies because we've seen them as great investments. Indeed, the company has made material returns to shareholders by investing in the likes of Google, Microsoft, Amazon, Meta, Nvidia, etc. We haven't owned Tesla, and we've owned very, very, very small amounts of Apple at times. But so partly the number of underweights has increased in the top active positions because we've been taking profits and selling some of these larger companies and recycling that capital into more compelling long-term opportunities elsewhere. So maybe just to expand on that a little bit more, here are the top buys and sells. Now, again, it's not always about the top 10, but just try to illustrate some of the changes going on in the portfolio. If I look at the sales to start with, there's clearly a mix of reasons as to why we sell companies. Now, there's many examples in here of companies that have been good investments for the company and for shareholders, and the stock pickers are taking profits and indeed have sold in many cases. So companies like Aon, Yum Brands, Workday, CVS Health, for example, they've been good contributors over the last, say, a year or so, and have now been sold as that sort of thesis has played out, and the stock pickers find other opportunities to move into. There are some other examples like Visa, where clearly it's one of the biggest trims in the portfolio, but we still own Visa. So again, very strong performer over a reasonable period of time, taking profits from the company, but still own it today. So it hasn't been sold completely, but we've been taking profits. And there are companies in here that haven't worked out as well. So Danaher would be an example of a company that's been a more challenging investment, and it's reached the point where the stock picker has decided now is the time to move on and recycle that capital into a more compelling opportunity, as Danaher really isn't working out as they expected. But again, if I just go slightly beyond the top 10, even if I look to the top 20 or so, you'd start to find companies in there like Google, Apple, you'd find Berkshire Hathaway, you'd find AppLovin, you'd find Qualcomm, Broadcom, you'd find a number of other US technology companies. So what you can actually observe, whilst there's quite a lot of difference in those 10 companies there, I think they're all US companies. And if you go beyond the top 10, there's actually a lot of other US tech companies that have been either sold or trimmed quite aggressively. So the broader picture, whilst it's not so obvious just looking at the names on the page, is actually our US allocation has generally been reduced by the managers through their stock picking. And if you look at the companies they've been buying, there's a mix of American companies, but also international companies. And there are a mix of different industries in there as well. So we're seeing, some different types of ideas coming through to the portfolio, given the slightly broader opportunity set today, basically. Thanks, Mark. So this slide just tries to give you a snapshot of what the portfolio looks like today. We show sector and geographical weights and exposures at the bottom of the slide. The top left tries to show you style tilts relative to the market. So whether we're buying cheap stocks or high growth stocks or high quality stocks on average. And what that chart really tells us is that our biases towards either cheap companies or growth companies or quality companies, all those biases are very close to zero. So it's telling you that the way we've intentionally built the portfolio is to not have a significant style bias. And you can see from the sector and geographical exposures that, again, we don't have significant risk coming from a big bet versus the market on any one of those areas. However, you will notice that we are underweight North America versus the market and slightly overweight UK and Europe. But again, the key driver of risk in the portfolio is the stock selection within that, more so than the macro top-down call. One other point I'd quickly make on this slide is beta in the portfolio. Beta in the portfolio should typically be around 1. We're not trying to this is not a structurally defensive portfolio, nor is it a structurally aggressive high beta portfolio. It's not intended to be either high or low volatility. It should be about 1. But over the last few years, our beta has generally been a little bit above 1, reflecting the fact that a lot of the best stocks in the world that we've selected for the portfolio have had high beta. And it's interesting that, possibly given some of the market changes, but primarily the stock changes that the stock pickers have been making, our beta has come down. It's now a little bit below 0.9. So, again, that's a result of bottom-up stock picking by the managers, but it's something that Craig and myself and the team here keep a good eye on. We keep analysing the risk of that kind of position, and we'll discuss whether we should make some changes to the allocations to the managers or the portfolio if some of these metrics get sort of too far away from where we expect them to be. But again, given the context of where we are, we think that's a sensible positioning for the portfolio overall. So to come to the outlook, clearly there are significant macro risks and a high degree of uncertainty in today's world, and that's probably an understatement even, and probably not something I need to tell people about. Really, it's fairly obvious at this point. But I think important for the Alliance Witan portfolio is fundamentals of companies are real drivers of long-term shareholder return. So whilst there's an awful lot of noise today around macro and people trying to take a bet on which side of some macro trade they should be on, at the end of the day, it's companies and their fundamentals that will drive long-term shareholder return. And the fundamentals of the companies we see in the portfolio remain very strong. And this is a key tenet of our process and our belief in the portfolio today being well positioned versus the market. That the fundamental strength of the companies we own is definitely there. And as Craig said, whilst we've been slightly behind the benchmark on year-to-date performance, we see an awful lot of value in the portfolio relative to that market at this point in time. So a disciplined, risk-managed approach to good, diverse stock selection, we think will stand investors in very good stead going forward. So that's the end of sort of our prepared comments. And we'd like to sort of open up to questions, and maybe I can bring back in Mark and Craig, and we can address some of your questions for you.
Thank you, Craig. Stu, I noticed we haven't had any questions coming in, so please do submit them if you'd like to. There's a Q&A icon at the top of your screen. Just tap them in there and they'll come through to us and we'll deal with them. But we have got a number of questions in advance, so we'll start with some of those. So I think you mentioned the changes since the Witan merger, Stu. They were a little while ago now, but someone is asking, what changes did you make? So perhaps Craig, you could just rewind and tell us a bit about the shifts that you made at that point.
Yeah, of course. So this was in October 2024, to remind you of the date that the combination actually happened. So the background here is that Witan also had a multi-manager approach, and they had a couple of managers in common with us. So they had Veritas, who we've also got on a global equity mandate, and they had GQG on an emerging markets mandate. And so those two managers, we just moved across in specie stock. In other words, we didn't have to sell the stocks that they owned for Witan to then buy them again for Alliance Witan. So those just moved across into our portfolio. They also had another manager that we like a lot that wasn't in the Alliance Trust portfolio previously, which was Jennison Associates. And we just took the opportunity to bring those across as well in species. So again, just bring the stock across. It's a manager that we've liked for many years. We actually invested with in similar portfolios for our institutional clients, and so we took the opportunity to do that at zero cost because we were just bringing the stocks across into the portfolio. And then at the same time that we were doing those changes and using BlackRock as a transition manager for us, it was a good time to make a business as usual change that we would have been making in Alliance Trust anyway, because we could do that at lower cost. And we replaced Black Creek as a manager at that time with EdgePoint, who is now in the portfolio. So there's two new managers from what you might have seen before, EdgePoint and Jennison, and one manager that's come out, which is Black Creek.
Great. Thanks, Craig. A couple of questions coming in now, both currency related. I think they're slightly different questions. One's asking, how are you dealing with currency risk? And the other's asking, what about the implications of the US dollar weakening on performance? So I think there's two questions there. I don't know who wants to take those. Maybe you, Stu?
Yeah, I'll have a first stab. Craig may have some extra thoughts as well, but I think I was talking a lot about the idea that stock selection is going to be the key driver of risk in the portfolio, and we're trying to avoid having macro risk really impact the portfolio in a meaningful way from a relative return perspective. So that includes currency, as well as geographical exposures, sector exposures, style exposures, currency exposures, any other types of exposures we can think of. We try to keep that to a limited risk because we don't want to come to a meeting and say that we've had some fantastic stock selection, but we've blown it all on a big currency bet, which we didn't want to have in the portfolio. So, currency exposures are relatively minimal compared to the benchmark. Clearly, US dollar is a key topic affecting absolute returns, but from a relative to the market perspective, we don't have a big position there. We are underweight the US, and therefore our US dollar exposure you can sort of read through. But I think also it's important that the stock pickers focus on currency impacts at the company level, and I think that's really where the main currency analysis and impact on the portfolio really takes place, is in that stock picking. It's more controlled at the total portfolio level.
Okay. A couple of people are asking about Trump's tariffs and what changes you've made. I think you addressed this during the presentation. I think you said that you hadn't changed any manager weights, but perhaps you'd just like to talk a bit more about that. What changes have been made directly as a result of Trump's tariffs?
Yeah, so I'm trying to expand on this a little bit. I think again, it's the stock picking changes that have been the driver. So because the managers have evolved their portfolios, we've not felt the need to change the total portfolio allocations at a high level. GQG and Jennison, I think, are two of the managers who have been a little bit more active than others in the portfolio. It's worth highlighting actually there are sort of two very big things that have happened this year, tariffs being one of them, the second being DeepSeek. Obviously the Chinese development of AI at a lower cost, which happened I think earlier in the first quarter. And I think both of those trends have sort of triggered changes in portfolios. In the case of Jennison, they've been playing AI, particularly in the US, for quite some time. They had very strong momentum and performance from that investment thesis for a while, but following DeepSeek and also partly related to tariffs, they've been rotating the portfolio a little bit away from technology, away from the US. They found value in some Chinese companies actually, but also some European luxury goods and so on, where they feel they're a little bit more protected from some of the impacts, and valuations are not quite as stretching, if you like. GQG is the other example. I think Craig also mentioned they're the manager that's more willing to change the shape of the portfolio. They have become, I would say, materially more defensive than I've seen before, or seen for a while, should I say. Their view, particularly given the rally that we've had in markets in the last few weeks, markets are actually in sort of full-on bull market mode right now. They're back to all-time highs, and there's a lot of optimism, I think, floating around equity markets, given the backdrop that we have today. And GQG thinks that you're not really being rewarded for some of the risks in the market valuations today. So they're more defensively positioned in a select group of companies they think are much more resilient and more reasonably valued. And as Craig said, that they lagged during the rally of the last few weeks, but I think they're sort of well positioned going forward. So that's been I would say, a change of positioning in relation to what's been going on and some of the valuations in the market.
And just to follow up to that, Stu, someone's asking about turnover. Would you say that turnover in the last 6 months, during this very volatile period, has been kind of on average or higher than average?
Yeah, I would say around average. So what do we mean by that? I think in periods of volatility, we expect turnover to be a bit higher than when markets are more benign, if you like. Usually because volatility in markets creates opportunity. So it's sort of the time where managers get to apply that competition for capital and make sure they've got the right stocks in the portfolio, and compare to whether they're being thrown up other opportunities that may or may not be better. So we typically expect to see a bit high turnover in periods of heightened volatility. But given that, I think the level of turnover this year has not been unusual. And like I said, there's been some examples like GQG and Jennison who have done a bit more than others, but I think overall it's been a reasonably normal level of turnover.
Another question here about volatility. It's been unusually volatile. Do we expect this to go away? Is it a temporary phenomenon, or is it sort of something we've got to learn to live with on an ongoing basis? Maybe Craig, you want to have a go at that one?
Well, probably a bit of both on the answer to that. I think we do need to recognise that volatility is just generally a bit higher these days than perhaps has been true in the past. You have more retail flows than you did previously. You get some leverage behind certain plays that are out there in the market, options markets and the like. So there probably is a bit more volatility than might have been the case, but certainly there's some unprecedented things going on at the moment with the unknowables around changing statements from the White House on tariffs almost on a weekly or certainly monthly basis. That you would expect might calm down a bit after a period. So a bit of both, but we do recognise that there's probably going to be some volatility for a decent period of time. There's quite a lot going on in geopolitics as well. This is not likely to suddenly go to a nice, simple, benign period for any time soon.
Okay. Sticking with you, Craig, there's one more about industry issue, I suppose. What's your view on discounts in the investment trust sector and Alliance Witan's discount?
Yeah, so I mean, the backdrop here, to put it in context, is that for the sector we're in, the global equity sector, and just generally across large cap equities, the average discounts are around kind of 10% that you see in the market. We're more like 4 to 5%. So we've benefited from a few things there. Firstly, we've performed pretty well relative to the peer group, which usually helps in terms of people wanting to buy the trust. Secondly, we're a FTSE 100 large investment trust, which helps as well. That makes it more attractive to a larger number of investors, including passive FTSE 100 trackers as well as all share trackers and the like. And so all of that is positive. The board have been consistent in doing buybacks when necessary, although it's important to note we've on average done a lot less buybacks than the rest of the sector, and yet still had a tighter discount to NAV. On the question of where do we see discounts going, I mean, it's difficult to predict in any short-term period of time, but they certainly are at the high end relative to historic averages, and that tends to be a bit correlated with where interest rates are, and so rising interest rates tend to lead to rising discounts. So if we see a reversal of interest rates to slightly lower levels from here, you might see discounts coming in. In fact, I've seen some articles saying that on average discounts have been coming in the last few weeks. And if we perform well, our discount will probably do even better than the average. And so we would be cautiously optimistic in where discounts might go from here, but the board have been consistent in making sure that discounts don't blow out to large levels for the trust ever since we've been managing it back in April 2017.
Okay, I've got a question here about data. What data do you use to assess market breadth, whether it will continue to broaden out, especially given the continued flow into passives, cap-weighted passive funds, which you could argue leads to greater market concentration? Craig, perhaps you want to take that one. It's something you've touched on.
Yeah, it's good. It's a good question. We monitor quite a few things there. So we clearly do monitor what's happening on flows in active versus passive, but not just in traditional funds. You can see that in what's happening with ETFs. So how much of the ETF market is in passive versus active ETFs, and that's changing. You're starting to see a lot more active ETFs being used in very recent times versus historically where they were all passive. So we monitor those kind of things. We advise on $5 trillion of institutional capital, so we see what's happening with the big institutional clients in terms of what they're doing on this basis, and we have all sorts of databases that look at the even larger universe of what institutional and retail clients are doing around the world. And then we actually monitor that breadth point. We look at the distribution of returns within sectors and how that's changing. We do analytics on how much of the returns in our portfolio and on the index are coming from the fundamentals of the businesses. So how much are businesses increasing earnings and all the things that you expect them to do over the long term, versus whether it's really just the price earnings multiple that's expanding or contracting. So we look at all of those factors to try and understand what's happening in markets to get a better understanding of our performance in context. And so we're constantly trying to understand, do we think we've got a portfolio that is continuing to build latent value, even if that hasn't yet come through in share price performance? And that's what gives us comfort with the managers. We're fine with the manager in some ways that's underperformed, if that's primarily just been because they've been in parts of the market that have been overlooked, but the businesses they're investing in are doing exactly what they expected or even better than they expected and the market expected. We're a lot more confident in that than where a manager has underperformed because they've called the fundamentals of the business incorrectly. So all of those factors are things that we take into account when trying to understand how we're doing, but also how the market's likely to do over the course of the next 1, 3, 5 years.
Okay, thanks. Stu, one for you here. You talk a lot about value in the portfolio, even though it's recently underperformed. Since you have a big weighting in the US, though not relative to the index, and it's the most expensively rated market, why do you see excellent value?
Well, I think it just has to go company by company. I mean, it's down to, there's a wide variety of managers in the portfolio focusing on deep value stocks, high quality stocks, high growth stocks. And what does value mean in each of those contexts? So we have Lyrical, our US value manager, who is focused on companies in very bottom quintile of PE in the market as their starting point of universe they fish in. So there are companies there that are on very, very low PEs compared to international markets, let alone the US market. Then there are companies that are either high quality companies or growth companies in the US, where actually the prospects are perhaps better than the market thinks they are, and they are reasonably valued versus those ability to compound or the prospects for future growth. So value means different things in different contexts, of course. But I think we have a portfolio of around 200 stocks versus around 3,000 for the index. Our portfolio looks totally different to the index at the company level. And when we look at the portfolio in aggregate, as Craig was describing, the fundamental strength of the portfolio has been growing more than the market over time. And that represents the fundamental strength of the portfolio. And that's where the real value comes from, because it's those fundamentals that drive return.
Great, thanks. Still questions pouring in. Random, sort of slightly left field one here. What's the house view on crypto, Craig?
Wow, that's a 4-hour answer to that one. I mean, look, there's a lot of what's going to change in the entire investment system going onto the blockchain, rather than how things are currently traded. So that will change the entire way stocks are traded, settlement systems, all of those kind of things. And so there's definitely interest in being able to access opportunities in that whole space. That's different to then saying, okay, does that mean Bitcoin price itself, for example, is cheap or expensive? We continue to do more work on all of that. Is it best to get that via private equity into companies that are doing work on this? Some of the tech companies that are doing work in the blockchain space, or some of the stable coins that already exist and you can invest in them. We don't invest in Bitcoin in this portfolio. This is a public equity portfolio only, but there are, of course, companies in the portfolio that are benefiting from some of the growth in the blockchain space. But I probably haven't got time to give it enough justice to the answer to that question.
Okay. Another one here for you, Stu, I think. Is lower beta purely a function of GQG becoming more defensive, or other managers making similar changes to their positioning?
Purely is not the right word. So it's not purely about GQG. I would say GQG's shift to defensive is a decent part of it. I don't know the number, but call it about half, let's say, of a shift in our beta. I think the rest would come from, as I was talking about, the stocks that have been bought and sold. A lot of those companies in the US were sold from the portfolio. So US has clearly been such a dominant driver in the last couple of years of market returns that historic beta is in US companies. So as we've been selling US stocks and buying some non-US stocks, the beta of the portfolio has naturally shifted. Beta, of course, in this context is more of a backward-looking metric. So we can debate what the future prospects of these are. But I would say, yes, it's a reasonable proportion of it is GQG going defensive, and the rest of it is other managers also changing stocks in their portfolio, but not specifically to be defensive.
Okay, let's just go to one of the questions we had in advance. You showed the contributors and detractors to from performance in the first half. I saw Diageo was up there. Someone's asking, why does Alliance Witan still hold this stock? It has been performing quite poorly for some time. Why is it still in the portfolio?
It has, and I think two of our managers hold Diageo, Veritas and Metropolis, and they still see a lot of value in the business. So I think maybe just a little bit of longer term context here. Metropolis wrote about, I would say, the consumer staples sector, if you like, a few years ago. So if you remember from the financial crisis, we had a collapse in interest rates. As interest rates were around zero, there was a lot of popularity for the search for yield was the phrase people used to use. So good quality consumer businesses, stable cash flows, compounding cash flows with high yield became very, very attractive. And the valuations of these companies expanded significantly over many years. And Metropolis, as an example, was writing several years ago that a lot of these companies, whilst they are high quality companies, and in the universe that they would fish in, they just aren't attractively valued for them. So they didn't own a lot of them. They just said a lot of these things are not growing significantly enough, and they're just too expensive now. And then roll on a few years, actually a lot of that sector has underperformed, I think partly because of lack of top line growth and partly the valuation. But having reviewed all that work, Metropolis said, look, even though they've underperformed, most of these companies are still not very attractive today to them. But there's one or two companies that had fallen into the more attractive space, Diageo being the key one. So, Diageo is probably 50% off its highs from probably peaked in around 2022, I would guess off the top of my head. And it's fallen about 50%. So we were buying it significantly below its peak, I think probably 30-40% down. It's continued to underperform a little bit from where the managers have built that position up. But the long-term view is this is still a good quality company where the valuation has fallen significantly and now offers a good margin of safety to long-term investors. And part of that opportunity was driven by inventory destocking issues, post-COVID, etc. very briefly, just part of the reason it's continued to underperform a bit recently is tariffs. Obviously, it sells Mexican tequila or Canadian whiskey into the US, for example. So people are concerned about tariffs. And without going into too much detail, the manager's view is basically that the price reaction to tariffs is overdone. So you've got a company that was already had a very decent margin of safety, and whilst tariffs are marginally negative for the business, they're not as negative as the market has currently priced it. So they see the portfolio is still potentially more attractive today than when they were first buying it. So they're still owning it for good long-term cash flow generation and capital growth of that company over long periods of time at an attractive valuation today.
Thanks. We've got a couple of questions on the dividend, but they're really, I think, for the board. One's asking any plans to increase the dividend. As I say, that's really for the board. Maybe there's one that maybe Stu could have a go at, which is, what do you see as the maximum prudent annual yield from the portfolio? So we're not talking here about Alliance Witan's dividend, but the yield that you get from the stocks that the managers are investing in.
Sure. I mean, the yield in the portfolio today is not dissimilar to the yield from the market. I think it's just worth re-emphasizing that the portfolio is run for total return, and there are definitely times when companies that pay attractive dividends are more attractive, and we tend to own more of them. And there are times when companies paying attractive dividends are less attractive from a total return perspective, and we own less of them. So the portfolio yield can change through time. So I wouldn't say there is a sort of a prudent yield that is static in the portfolio. Currently, the yield is similar to the market yield in today's portfolio. So that's around 2%, a little bit above 2%, I believe. I think that's very achievable in the portfolio we have today.
Okay, great. Well, look, I think we're coming towards the end of our time, and the questions seem to be drying up. I'll just give it a few more seconds in case anyone wants to submit another one. I see there's someone asking, can you create a version of Alliance Witan for small caps and for fixed income? That's a nice idea. I have to think about that one. I don't think there are any others. So I think with that, unless Stu or Craig, you have anything else you wanted to say, I think we'll say thank you everyone for attending. If we haven't got round to your questions and we have your email address, then we'll get back to you. If we haven't got your email address, and I know some of these questions are being asked anonymously, then please do resubmit them if you could be so kind through our website. There is an email address there for you to send questions in, and they come through to us and we will answer them. But Craig, Stu, anything to add?
Don't think so. No.
Great. Well, okay. Well, we'll say thank you very much, everyone. It's been great having your company, and we look forward to seeing you again in the next webinar.
Thanks very much.